All right, welcome back to the Host Financials YouTube channel. So most people think today we're going to talk about how banks read your credit report, the insider's review for credit reports for business funding. This is a three-part series. We're titling this the Business Credit Playbook and how to help you get business approvals. So most businesses think that a good credit score means they're ready for funding, when at the same time, you can have a 740 in the lender system. It can get flagged, it can get downgraded, or it can get denied because banks don't see what you see. They're reading your report through a completely different lens. In this first episode of the Business Credit Playbook, we're pulling back the curtain on how banks actually read your credit report so you can stop guessing and start thinking like a lender and finally understand what really drives approvals. We've helped hundreds of entrepreneurs secure over millions of dollars in 0% business funding by learning to see credit reports the way underwriters do and not how consumers do. This is just the beginning. Over the next 3 episodes, we'll walk you step by step through everything from how lenders read your report to how to position your business profile to how to execute your funding rounds the smart way. So if you're serious about mastering business credit and getting high limit business credit cards, do not skip this one. My name's Austin. I run this channel with my wife, Susie. We're parents, we're business owners, Bible believers, teachers, entrepreneurs, you name it. And we know how to use 0% interest business credit to scale a purpose-driven business. And so on this channel, we show you how to read your reports like a banker and position your LLC for real funding and build relationships with lenders fast. If you're interested in anything like that, consider subscribing and liking this video. So without further ado, let's dive into it. So how banks actually read your credit report. In this first session, we're uncovering how lenders actually read your credit report and why the same 750 credit score that looks great might not be as great as you think. It could get denied by the bank. So we're going to take a look at the lender's lens, how to analyze your credit report from the eyes of a lender. I'm talking about major banks, credit unions, even regional banks. We're going to talk about the difference between perception versus reality when it comes to your credit report. We're going to dive into key factors that trigger approvals or denials. And we're going to talk about how to optimize your report for business credit cards and lines of credit. So by the end of this, you'll be able to look at your credit report and know what a lender likes and, how to make sure you don't show any risk, right? So let's talk about the consumer review versus the lender review, right? This is the perception versus reality section. So, for example, a lot of people think just because your credit score is high, it looks good. When lenders, they're looking for credit profiles that not just have a high credit score, but your credit doesn't look thin. You can have a high credit score with one credit card, but that makes you look thin and risky. So those type of things, these are things that lenders are looking for. They want profiles that have weight on them, that look like they have a good mix. They're thicker profiles. Most people just focus only on their score. What makes a good profile? Account mix, age, utilization, and exposure. You don't want to be overexposed. A lot of people consumers think if I just have a 680, I'm good. If you have a 680 with an optimized thick profile, okay, great. But when lenders see 680, they're automatically on the defensive. They're looking for negative, high balances, or weak limits. That's why you have a 680. And so, and the last part, if I didn't just prove it right now, is a lot of people look at their credit reports visually when really you're supposed to look at it through data and scoring models. And so, don't think of them as scores, think of them as risk models. A 750 credit score built on two $1,000 limit credit cards is weak compared to a 720 credit score, which is 30 points lower, backed by 5 seasoned credit cards totaling $50,000. And those cards have been around for 10 plus years. Now that's a profile that lenders want to lend to. So just keep it in mind. So like I just shared, a strong score doesn't mean a strong profile. Your credit looks good, but it isn't, right? A lot of people have credit scores, but their profiles are underdeveloped. They have a weak credit mix, no car loan, no mortgages, no pledge loans. It doesn't look like you've paid anything off. You've been able to handle large amounts of debt. Also, if you have 3 or 4 cars, all the limits on all those credit cards are $2,000, $1,000. Like if you add them all up and they're below $15,000, That's not good. Your profile is weak and it's really, really thin. And so also, some things that you need to take into account is your balance, your utilization. Each card should be below 30%, each individual card, not just your profile overall, right? And at the same time, even though you don't have, let's say you don't have a Chase Sapphire card, you're working your way up to it. There's no reason why you can't open up a bank account and keep the minimum amount in there. Start building a relationship with those banks now that have the products that you want. So by the time you're ready to apply for their major products, it's easy because they know who you are. And so the lender system interprets patterns, right? You might look excellent at Credit Karma. They might tell you can apply for this, that, and your mama, but you still might look risky to banks like Chase or Citizens because your capacity and seasoning just aren't there. And when I say seasoning, I'm referring to the age of the profiles or the trade lines on your profile, as well as how long you've had your business account open at certain banks. So what do banks actually care about? Here are some 6 data points that lenders analyze. 1, they analyze the age of the accounts. The longer the history, the lower the risk. The second thing, utilization. Like I mentioned, below 30 on each card. Payment history, straightforward. No late payments, no derogatories. Inquiries, not too many recent apps. A good rule of thumb is if you're going to go apply for a big credit card, you don't want to have applied for anything in the last 90 days. That just looks good. Credit mix. You have some revolving credit lines, which would be a credit card or a line of credit, but you also have some installments like car, pet zone, whatever. That makes you look like a mature borrower. You look a little bit more attractive. And then also when it comes to credit limits, total available credit limit capacity of how to handle large credit lines, which means you have a bunch of cards and it shows, oh, okay, I'm currently managing $55,000 in debt if I add up on my cards. That looks good because then banks feel more comfortable trusting you. So your credit report is a resume, and each factor is very similar to like experience with credit. And so perfect resume on paper means nothing if the work experience isn't there. Kind of the same logic with your credit report. So, the number one silent killer when it comes to credit applications, we talk to clients and we consult day in and day out. And a lot of them, it's utilization. They just don't pay their cards down. Guys, pay your cards down. Run it up and pay it down. Run it up and pay it down. If you run it up and pay it down, banks they're going to want to give you more money. That's just the way it is, because they go, wow, okay, he's using our product. This is awesome. So keep every revolver line below 30%. If you're about to go apply, you want to look real attractive, keep it below 10%. Also, pay down your balances before the statement date, not the due date. That's just a pro tip. But banks have different tiers when it comes to borrowers. That's what we have over here. When the underwriting system or team sees a card over 30%, your profile can drop from tier 1 to tier 3, which means a difference of $25,000 of the limit on that card. Some of you guys can get approved for business cards, but you can't get approved for the highest limit without these little tricks of the trade. And so you want to be at the top tier system, because they'll approve you. But like this box over here talks about, there's a different tier system. You want to be at the top tier system. So let's talk about seasoning. Seasoning matters, like Lowry's, like lemon pepper, like onion, like garlic salt. You know what I'm saying, right? Deep dive, age and mix. So seasoning timeline. Lenders want you to have at least 2 or 3 years of consistent revolving history, especially when it comes to primary cards, personal cards. Don't open and close cards too often, especially if you're going for funding. Now, if you're travel hacking or doing some other stuff, like, okay, I can see that. But that doesn't make you look good for funding. Instead, if you have business cards, you can do that because you can close that account and not impact your personal credit, because business cards don't report to your personal credit. So, we normally say 6 months is the minimum seasoning period or gardening period for a new credit card. You want it to just sit and report. That's what you want. And then you want 4 or 5 cards, right? And maybe one installment loan or an auto loan. That's a good starter mix to have. Installment loans are easy if you don't have a car loan, or you just do a pledge loan, like the Navy Federal Pledge Loan reports as a regular loan. Kickoff, self lender, all those credit builders, they help a little bit. And then also you might want to throw in the authorized user trade line. That'll help with the overall age in your profile as well. So think of seasoning your cards like marinating them, right? They want to see counts that have been soaked long enough. They've been sitting there. So credit limit threshold. So let's talk about limits and capacity. The underwriting teams at most banks, they look at your capacity to handle large sums. This is why we say if you combine all the limits of your credit card and it looks like it's below 15,000, it's too low. Why is that? Well, it's too low to qualify for tier 1 type of funding. You'll qualify for funding, just maybe like $2,000-$3,000. But if you want the maximum amount, you want tier 1 funding, you need to show that you handle debt. And so and here's a good rule of thumb: whatever your total limits are across all of your revolving lines of credit, specifically credit cards, don't include installment loans and things in this calculation. If you add all those up, whatever that number is, the max you can get on a potential credit card is 3 times the amount of that number. So if I have 3 credit cards for $2,000, that means with $2,000 limits, that means I have a total of $6,000 limits available to me. That means the max I can get on a card is maybe 18,000. So that right there is huge. So like we mentioned, like ideal is maybe like 25,000. Actually, I would go as much as you can, but stay below $60,000. If you can stay below $60,000 of a limit, then you're pretty solid. You're looking pretty good. Lenders want to know you can handle 10 to 20,000 responsibly. And so high limits create social proof within your credit profile, and then they feel more confident giving you more money. And so that's the direction we want to go. Now, some overexposure warnings and signs. These are things that we've talked to clients. Some clients be like, man, I've tried to apply for this and it didn't work out. And we take a look at how many accounts they've applied for, or how many cards or products they've applied for in the last couple of months. And I was like, well, that's why. I don't care how good your credit is. You look desperate, right? If you apply to too many accounts, you look credit hungry. You look clingy. A good rule is 90-day rule, right? 3 inquiries in 90 days. And then rotate. 3 inquiries in 90 days. That means you can apply for cards 4 times a year, right? At once a season. And you want, like I mentioned, you want to apply strategically and avoid personal accounts, opening up new personal accounts 90 days before you go for the big cards for funding. And don't open accounts you don't intend to keep. Remember, each one resets your age, because your credit age is an average of how old all your cards are. So if you have one 10-year card, then your credit age is 10 years. But as soon as you open up 2 more cards, that age just dropped from 10 years, because now you got some newborn babies. So the average age of all those cards in your profile drops. So that's the thing, man. So anyway, you don't want to overexpose yourself, because banks, they want to give money to people that look like they don't need it, if I'm being honest with you. All right, here's some things that are instant denial triggers, just in case you didn't already know. Late payments, missed payments, any derogatories, charge-offs, collections, high utilization on any card, anything above like 50, like 40%, like it's automatic denial. Any new accounts you had in the last 90 days or 3 months. Mismatch and outdated addresses. If you put one thing here and the wrong thing there, or your ID or your business number or your business name, like banks, their job is to manage risk. They're going to look suspicious. They're going to go, hey, what is this? And then also thin profiles. You just don't have enough credit in your profile. They don't feel comfortable lending to you because you just don't look like you've ever managed this type of money. And so one of these can cause you to go to, manual review, which almost means you will be denied, right? And obviously, what we're talking about, applying and getting approved for these credit cards. There's a huge difference between applying online and applying with a business relationship manager, or with, and those are people that we have on our team that we connect to our clients. Because one, you just go to the algorithm, which is trigger happy, or the other one, they'll hand you to the underwriters directly, and they'll put it together. And so these are just things to keep in mind if you really are trying to take this seriously and get some funding for your business. All right, now how banks weigh risk depending on the product. Something to keep in mind. Depending on the product you're going for, positioning yourself changes. And so there's some general rules, but depending on the nuance, it changes, right? So business credit cards, right? You want clean report. You want some aged accounts. You want some limits. You want to have low utilization. Those are things that matter the most when it comes to business credit cards. That's what they want to see. So you want to focus on your personal profile. Now, if you're going for a business line of credit, they want to see your relationship with them. How long you've been banking with this? How much money is coming in and out of your account, as well as your cash flow that's come in and out of the bank. So open a business checking account for about 90 days and move some money in it. That will help a ton on top of your optimized profile. And then for term loans, small business loans, things like that, you'll just need all your documentation. So if your business is broke, you're not getting any money. So that's it. And so, sometimes entrepreneurs go, I don't have any money, or I want to get approved for anything. I'm like, you just apply for the wrong product at the wrong time. So, business credit card readiness checklist. This is something that I would just pause and screenshot this, because this is what we teach our clients all day and what we walk them through even before we sign them on. Right? You have a 700 plus credit score. You have no late payments. Your utilization is below 30. You have more than 3 credit cards to your name, and the limits are all over $5,000. They add up to about 20 or 30,000 completely. You've had most of those accounts sit for about 6 months. You haven't opened them just recently or closed any of them, right? And you've had less than 2 increase in the last 90 days. This is a baseline. If you're trying to get a 50K, 100K business credit card approval, like, this is what you have to do. Now, once your personal profile looks like this, then lenders will be competing to give you funding. Now, there's obviously still some tricks of the trade. That's why this is a 3-part series, because there's a lot more to it. But if you have all these boxes checked in the checklist, you're actually in a really good spot, and you have the ability to get funding for your business. And so, and we recommend you guys reaching out, because we'd love to help you if you're in this position right here. I'm pretty sure we can get you some great funding. So remember, this is the business credit card readiness checklist. Let's talk about the line of credit readiness checklist. You have an active bank account, business bank account with them. You've been making deposits and withdrawals over the last 3 months. They're going to monitor it. They're going to take a look. You have low utilization. You have a clean history. You have the aged accounts and your credit capacity. You look like you've been handling debt. So lines of credit, they're relationship driven, like I said. And so if you have these things lined up, you look like you should be in a good spot. So something else that we tell clients is, if you want to stay fundable, if you want to keep yourself in a good space to be able to access funding, you need to monitor. You need to monitor your credit often, right? So we recommend services like MyScore IQ, Identity IQ, things like that. This isn't a sponsored moment or section of this video. We just encourage you guys to take a look and monitor your credit. It can be through Experian. I don't care. Just make sure you're watching any hard inquiries or anything pop up, because that might hurt you at the last second, because it might be forever to get it off, even though it wasn't your fault. All right. So, and this kind of goes back to what we were talking about at the beginning of this session. What are some myths now, misconceptions, that 680 credit score is good enough? No, that's subjective. Like, even if you have a 680 credit score, how thick is your profile? How good is it? All these things are important. Your personal credit doesn't matter for your business. Yes, it does. Unless your business is bringing in about 50K a month, your personal credit is what they're going to use to guarantee this loan, or personal guarantor it. That's what it stands for. Paying on time that counts. No, you need to pay earlier, right? These things matter if you have to make a payment. All banks pull the same scores. No, they don't. Chase, They like Experian. Bank of America, they like Equifax. Everybody has a different bank or bureau that they prefer. Depending on where you're at, you might see a double pull. They might pull two different bureaus, but they're not all created equal. They all move differently, and so removing inquiries instantly fixes approvals. Well, one, removing inquiries isn't that easy. Depending on where, it's not the easiest thing, but it can be. But it doesn't automatically fix the approval. There's so many more things you need to do to make sure you have a solid profile. And so if you want to know your fundability, right, we put together an internal document that we go over. All we need is a copy of your credit report, and I can tell you, hey, you're on track to get funding, and if not, this is what you need to fix. And so all you have to do is reach out to us, reach out and say, hey, I want to learn more about business funding. You send over your credit report, and we'll send you back a fundability report. And it just shows you, hey, here's everything going over your credit report. Here's everything that you need to tweak and fix to get you in a great spot, so you look like this checklist right here. And so if you're interested in the fundability score, just send us a message, and we love to, we'll have the link in the description. Send us a message, and we would love to respond with that to show you that. And so we'll break down your credit report the same way that lenders do from their position, and that hopefully put you on the right path and set you off right. And so, and we also offer a mentorship, right? So you can work with us. We operate a flat fee. We don't take a percentage of your funding. We can help you optimize your profile, build banking relationships, stack 0% business credit cards, and get between $50,000 to $250,000 in approval. And this will also include a lot of documentation, like our funding blueprint, all of our data points, all those things. It all comes with it, with our program. And so I appreciate you tuning in for this video. The next video we're going to cover is talking about like positioning factors. We're going to dive deep into like how to build a profile that deserves high limit approvals. And so how do you position yourself well for that? And so it's going to cover how you structure your relationships. Now that your profile is set up and optimized, how do you structure relationships and then maximize those limits to get automatic approvals? And if you've been following along in this series, you can just click the link to the video at the top and just kind of keep moving your way through. We appreciate you guys participating and supporting the channel. If you got any value out of this, please hit that like button and leave a comment. Let us know what you think. Other than that, take care, and we'll see you in the next one.